Morgan Stanley's Chris Toomey runs one of the highest-rated private wealth advisory teams in the country. Joins me now here at Post 9. Welcome back.
Thanks for having me.
You still don't like the market?
I'm still cautious around the market.
Why, Toomey? What's going on here?
I want to be a bull, but I have to.
But
look
what prevents you from being one? I mean, a lot of people have turned.
Well, I mean, look, a lot of the things that we thought was going to happen last year happened, right? They were predicting a lot of good things happen, right? So inflation came down. We didn't go through an economic recession. We had an earnings recession. But if you look at earnings were actually negative for last year, right? So 219, 2022, markets pronounced 219. We're expecting 215. We're right in the middle of this. Financials, big expectations, not a really great response. So earnings weren't great. We didn't get the rate cuts that we were expecting. You look at the market.
You weren't expecting rate cuts last year.
Oh, we were totally expecting rate cuts last year, and then we got 2 rate hikes. That's my point. When we were talking last year, I said if we get rate cuts, it's probably because there's something wrong with the economy. We go into a recession, or we've got a problem with all of this debt outstanding that's going to have to be refinanced. Now, we were able to thread the needle by having the economy continue to do reasonably well, but earnings were actually negative last year,
sure,
right?
But interest rates have come down so much from the peak. Inflation's come down a ton since the peak. Fed seems to be done with the hiking. You've gone through the earnings recession. You know how the markets are. You've done this as long as anybody.
Right.
Look ahead.
No, and when we are looking ahead, right, we're in a situation, right, where valuations, while not necessarily a good predictor of market returns in the short term, in the long term are actually pretty good, and valuations don't look very good. Earnings expectations, 10, 12%. We think that's probably high because we think margins are really probably going to have to start contracting. Liquidity, right, which was the great equalizer last year, which was caused by the regional banking crisis and all of the activity that we put in to stabilize that, all of that stuff starts rolling off in March, right? So you're in a situation where earnings aren't looking great, valuations aren't great, and liquidity is being pulled out of the system. So I think caution is probably the right word.
Until when?
I think until you start to see a revaluation with regards to the market. I think you're right. The fact that the Fed is not talking about raising rates is a good thing, but the fact that the market's pricing 6 rate cuts is a problem.
Sure,
right?
but I mean, I think we can agree that 6 rate cuts seem a little bit adventurous, over our skis.
Yes.
Right?
Right.
So what? The fact of the matter is they're going to cut. The regime has changed from hikes to now cuts. And in the past, when the Fed's your friend, equity markets do well.
That's correct. That's correct, except for the fact that we've had zero interest rate policies for about 10 years. So you're right, rates have gone from 5% down closer to 4%, but we're in a situation where you've got a number of businesses that have been underwritten at a 0 risk-free rate, right, that are now refinancing debt. So we talked about this last year, up to 2025, $5 trillion worth of debt has to be refinanced, right? $120 billion, particularly in commercial real estate this year alone, right? One of the things that drove the markets down going into October was, right, the 10-year shooting up with concern about the amount of effect that all of this debt issuance is going to have on the U.S. deficit, right? So that's not going away, right? And so the concern I have in the debt market is specifically around the fact that you could see a crowding out effect when all this treasury reissuance and all of these refinancings start coming into the market, pushing yields even higher, because we really see that as the thing that's driving the market. I mean, Josh hit on that as well with regards to volatility correlating with regards to the 10-year. I think the good thing that we could see is if we do see stabilization within rates, you've got a lot of dry powder sitting out on the sidelines.
Yeah.
You could start seeing some M&A activity.
Aren't we already seeing the so-called green shoots of that? Right? I mean, rates have stabilized. They definitely have stabilized.
Well, they were stabilized, but now they're starting to shoot up again, right? Because of the concern with regards to everyone expecting this rate cut in March that is now not necessarily looking as rosy. And to your point, I think if you look at fourth quarter, so much of that performance was chasing, right?
Oh,
chasing
for sure.
and chasing and chasing. And now people are like, wait, do I really want to own this thing at this level? And if rates are starting to go higher, you're going to get a lot of weak hands selling in this market.
What's your best investment? Client calls you up, says, the market's been going up a lot. What are we doing? What are you doing? What's the best play?
So I think the two areas that we really like, if you look at equities, we think it's probably going to be a suboptimal return. And there's other alternatives now that rates have gone higher. We do still like private credit, where you're at the top of the capital stack and you're collecting very aggressive cash flows.
Double-digit returns.
12%, right? Yep. And then the other area that we're starting to see some opportunities are within triple net lease with regards to businesses that are going to have to start selling critical assets, that we're getting long-term leases and getting another 8%. The one big issue for investors is the breakdown between the bond market and the equity market, right? It used to be when equities were selling off, bonds would do well, and we're in a situation where they're correlating again very closely.
Well, we had historic rallies in both in November.
And now, as bonds are selling off, equities are selling off. So where do you get that diversification? So you really need to start looking at other alternatives.